Hi, I'm Al Brooks, and today is July 21st, 2013. I am a professional trader. I've traded for my accounts for about 26 years now, and I've had a number of requests from people asking me to speak more about foreign exchange, the Forex market, so I'm using this blog today to do that. Earlier this week, I gave a webinar for Futures Magazine and Traders Expo. I talked about a number of trades within that webinar, and I do not know if the webinar was recorded and posted. Because of that, I am going to be talking about one of the trades today to illustrate a point about Forex trading. Now, when I look at magazines and websites, I come away with the impression that this is how you're supposed to trade. You're supposed to add a lot of indicators and then place trades and make money. And I totally think this is wrong. You know, if you listen to the traders on Fast Money or any professional trader, you don't hear them talking about Fibonacci's and bands and oscillators and cycles and Gann lines, and all you hear them talking about is support and resistance and moving averages and prior highs and prior lows and trend lines. And this is that same chart, and this is how I think most professional traders view the market. They draw trend lines below trends, they put trend channel lines above, and they look for patterns. You know, for example, here 3 pushes up, a triangle, so they'll short that in a bear channel. Here we got a first entry reversal, a second entry, and then a third. They'll probably buy this, or they'll wait for this strong bull breakout, and then they'll buy the breakout of the triangle. Another strong breakout, they'll buy the resumption of the trend here. And this is how I think most professional traders trade. This is price action. They're just looking for how the bars appear on the chart and the patterns that they create. This is a common question that I get from traders. You know, what time frame does price action trading work on different time frames? Does it work on different markets? Well, this is to illustrate that point. If you take away the vertical axis, the price, and the horizontal axis, the time, charts look the same. And here are 3 charts, and if you did not see these labels below, you would not be able to tell that this is a daily chart of the stock market, General Electric, during the 1987 crash. You would also not be able to tell that this is a 1-minute chart of the Forex market, the euro versus the dollar, or that this is a 5-minute chart of gold. And that's because price action, the movement of prices, is a reflection of human behavior, and it's been that way since the beginning of time. I've looked at charts from 100 years ago, and if I remove the labels, I cannot tell them from today, even though most major markets are traded 70% by computers. The price action is still the same. Some basic rule for traders. Traders, not investors. You know, day traders, traders holding for a day or 2 or 3, right? Markets gravitate toward balance. The bulls and bears. The bulls want to buy, the bears want to sell, and the market quickly gets to a price where both of them can do what they plan to do in the market, right? And that means confusion. Most of the time, the market is sideways and confused. Nothing wrong with that, right? You know, that's what the market is trying to achieve. It's trying to find a price where the bulls are happy buying and the bears are happy selling. If you take trades during those times, the probability of any long and the probability of any short is going to be between 40 and 60%. Sometimes it favors one side, 60%, but it's still 40% for the other side, and the other side with the lower percentage probably has higher profit potential. So if you get better probability of success, you probably have less profit left to the trade and probably a stop further away. It's just a trade-off. Fundamentals are useless. They're okay for investors holding for months at a time, but for a trader, fundamentals are useless. And I think that's one of the main reasons why the CNBC show Money in Motion went out of business, because they stressed fundamentals and the viewers knew that it was nonsense. It had nothing to do with making money. You can use any time frame, but I think it's a mistake to use more than 20 bars per hour, because you will not be able to do it profitably year after year after year. Another basic principle of trading, you should be going for a reward at least 2 times as great as your risk, except in a very high probability situation, in which case you can go for a reward equal to your risk. Remember, the higher the probability, the lower the reward relative to risk, because otherwise the trade would be too perfect, and perfect trades cannot exist because there has to be someone to take the other side, and there would be nobody to take the other side. I'm simple when it comes to how I view markets. They're either trending or they're in a trading range. A trend begins with a breakout. As soon as the market starts to have pullbacks, the breakout is replaced by a channel, and then the channel is followed by a correction, and that results in a trading range. And then eventually you get another trend. You get a breakout in either direction. I spend 99% of my minutes during the day looking at a 5-minute E-mini chart. But every 5, 10, 15 minutes, 20, 30 minutes, depending on how active the E-mini is, I'll take a look at this window, which has 6 charts: the bonds, gold, the euro versus the dollar, Forex, the dollar versus the yen, Forex, crude oil, and natural gas. Most of the time, the market looks like this, and I don't trade it. All right, when it's like this, I don't trade it. Here, I don't trade it. This is where I make my money, right? This is where I make money. This is where I make money. It's hard to sit there for an hour or two at a time waiting for these brief breakouts, but that's what you do if you want to make money. So when I look at the chart, and if I see the early stage of a breakout, I'll place a trade. So I glance over at these charts, many times throughout the day, just for 2 seconds at a time, looking to see if one of them is in the early stages of a breakout. And if it is, then I'll place a trade. For example, here's the euro versus the dollar. And you can see it's sideways, and we have a wedge bear flag, 3 pushes up, 1, 2, 3. And instead of a bear breakout, we have a bull breakout. Had I noticed this chart at this point, as this bar is forming, I would wait for the close. If it closed in the top half, top third, I'd buy the market and put a stop 1 tick below. If I happen to see the chart at this point, I'd buy that close and put a stop below the bottom of the breakout, which is below the low of this bar. Now this bar is interesting. Closed in the middle, actually it closed below the midpoint, closed below this high, and a fairly prominent tail. And you look back and you say, well, that's a fairly prominent tail, and so is that. And although these bodies are big relative to this, they're not particularly big overall. They're only about 10 pips tall. So this is not a strong breakout. So although I'd buy that close and I'd buy that close, I would not buy this close. At this point I'd say, I better start to look to buy pullbacks. Now the entire breakout is only 20, 30 pips tall, right? So I'm not going to go for a 20 pip scalp. I'm going to go for a 10 pip scalp. Initially I want to buy pullbacks, right? Bears will look at this and say, expanding triangle, 3 pushes up, 1, 2, 3, failed breakout. To me, we have a bear flag and a bull breakout. Whenever you have a bear flag and a bull breakout, the market usually has 2 legs up. That means that there will be a pullback and then a second attempt up. I want to buy the pullback. Since I believe there will be a second attempt up, I think someone shorting below the low of this bar will not make a profit. So if they're not going to make a profit, that means it's a bad short. If it's a bad short, it's a good long. So if I'm trading this chart and I look at it, and this is the first time I see this chart, I said weak breakout, I want to buy pullbacks, I'll place a limit order to buy at the low of this bar, okay, at 37. And I'd put a stop below the low of this bar. So my stop would be at 19, so I'd be risking 18 pips. I would also place a limit order to buy more, about 10 pips down. Why 10 pips? Well, the bears, if they're shorting below the low of this bar, they're getting in at 36. They want to get out at 26, which means the market has to fall to 25. It has to fall 12 ticks below the low of that bar for them to make 10 pips on a short. I think they probably will not make their profit. So I think the market will not fall 12 pips. It might fall 10 pips or 11 pips, but probably not 12. So for me, I'm going to buy this low. I'm going to look to add on 10 pips lower. So I'll try to buy more at 26, and I'll put a stop one tick below this low. Alternatively, I could simply place a limit order to buy 10 or 20 pips below this close. So try to buy at 36, which corresponds to a pip below this low, or try to buy at 26. Again, stop one tick below this bar. And this is what followed, right? So to me, I'd buy here, and I'd try to add on 10 pips lower at 27. And look what happened. The market fell to 26, so I would have been filled on my second order. So I'd be long at this low and 10 pips lower, and I would get out of half at this original entry price, and I'd try to get out of the other half at this close, because that was my original target. Traders who are buying closes here and then buying more here and buying more here, it's a reasonable thing to do. The market usually tries to come back to that close after any pullback. As long as it stays above this low, chances are it'll come back to this close. Chances are, high, 70%, 80%, right? So that's where I'd go flat, and you can see lots of traders did just that. And that's all I had to say about that trade. I have a couple of websites, brookstradingcourse.com, and I sell videos, 27 hours of videos on the site, and they go into great detail about price action trading. I have a second website, brookspriceaction.com. Traders run it. I provide content, and I also speak all day long in a trading room. I talk mainly about the E-mini, but I sometimes talk about commodities and stocks, and I talk about trades. And again, everything that I do is on price action trading. And I appreciate your time and attention. Thank you.